Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in today's show, we got somebody in the basement of his home. Got some nice cars behind him. Today's guest embarked on a wholesaling journey back in 2012 and discovered a need for low-income affordable housing in his area instead. Tom Cruz utilized creative financing and began purchasing properties. Today, his portfolio generates over $650K in passive income monthly. Welcome to the show, Mr. Tom. How you doing, brother?
Good, man. Thanks for having me.
Let's start with the journey. Let's start with the pain. Let's start with the wholesaling, like that little hamster wheel we were just talking about. At least you got in. What made you want to get into real estate, Tom?
Man, it was by accident. So I bought a condo originally with the Obama tax credit, the 3.5% on FHA. So I got in really cheap. I lived there for a few months. I decided to buy a Doberman Pinscher, a dog, and found out that he was a prohibited breed after I bought him. So I couldn't live in that condo anymore. Like I was either had to get rid of the dog or get rid of the condo. So I was so upside down on the condo. This is all after '08, and I only had 3.5% equity in it. So I ended up renting it. And that was kind of the aha moment. I rented it same day. I rented it for $500 over my mortgage. And at the time, I hadn't even started wholesaling yet. I was doing like marketing and side hustles and web design. So I just kind of sat down. I was like, wait, I'm making $500 per month. I never talked to this tenant. And she just, at the time she was Venmoing it. She was Venmoing the rent every month. I was like, I should look more into this. So at that point, I was like, well, how do I get more money on top of the marketing? So I started looking into real estate, looking into the wholesaling, and then I started wholesaling. And that's kind of where it started taking off. And then I started buying more and more condos before I realized that HOAs and condos were, for me, not the way. And then I got into single family.
So, Tom, I have to make an observation. You started in 2012.
Yeah.
It was probably not the right time to get into real estate. What do you say to people today that are saying now is not the time to get into real estate? It's never the right time unless Tom is ready to get into real estate. Am I correct?
Yeah. I mean, that's the case that it's never going to be the right interest rate environment. It's never going to be the right inflation environment. It's never going to be the right purchase price environment. It's never going to be all perfect. And even since I started buying, back then, and I continue to keep buying even today, I'm buying 7 to 10 houses per month. Even with interest rates high, I don't care. Section 8 pays above market rate. If the cash on cash percentage return is there, that's all that really matters to me. So even when COVID hit, kept buying. Even when interest rates spiked, kept buying. Even when inflation, spiked, kept buying. It also helps that Section 8 properties are pretty inelastic price demand. I mean, they might go from 60,000 to 70,000, but they're not going from 60 to 130 like that. So that helps a lot on the acquisition side.
Tom, when you bought the condo, if I heard you correctly, you couldn't live there because you had a dog. So you had a choice either to leave the dog and get rid of the dog or to leave the condo. And
Right.
you chose to keep the dog, correct?
Yeah.
So I have a Jake and Gino student who this year decided to move back to England.
Okay.
And he has to bring his dog. But guess what? He can't put it on the plane. He's going to take a boat across the Atlantic with his dog to bring it to England. So I thought you were crazy, Tom. But this dude is even more crazy because he's going to spend like 10 days on the Atlantic with his dog. So for you dog lovers out there, that is really how would you say? I mean, that's a commitment in and of itself, isn't it?
That is a commitment. And I mean, I love that dog. I mean, that was, back then he just recently died, but at the time, I mean, it just made sense to me. There was no way I was going to get rid of it after already kind of bonding with it and training it. And so, but no, I get it.
Oh, dude, what were the challenges when you got into real estate? Give me some of the limiting beliefs, some of those things that you hear your students today saying, I don't have the money, I don't have the experience, I don't have the time. It's never the time or the money, folks, if you're listening to this. Those are two objections that we all want to put up front. There's always something else. Peel back the onion. Tom, peel it back for me when you started.
For me, it was the risk of not renting out the unit. That was always my concern. That limiting belief kind of exploded once I rented out my first unit, like I said, in the same day. But even then, I was more cautious. When I got my second unit, I actually advertised it before I even put it under contract. I put it up for rent, put it on Craigslist, saw how much demand that it had for it. And then I built a waiting list of all the people that were interested. And I told them, hey, look, I'll close on this in 30 days. Let me know your phone number, email, and details. And that's how I started. And that's basically how I continue to grow one by one until I was able to start building portfolios. But the big limiting belief for me is no one's going to want this condo. There's a million other condos. Why are they going to want my condo? But there's a never-ending demand for affordable housing. There's a never-ending demand for, that $1,100 to $1,500 a month price point. And that's just kind of what I started off by taking advantage of.
Walk me through that very first deal. Tom Cruz is there on his first Section 8 affordable housing the night before. He's got some stomach cramps. He's got a little bit of the sweats. He's like, dude, this is a little scary. I've never done this before. Walk me through the feeling of it and then that execution after you closed.
So there was no nervousness because the first Section 8 property that I bought, I didn't know was Section 8. So I bought condos up until that point, and then I got into single families. So I bought a couple single families, but eventually I started running out of money because I was buying 120 to 140K units. And I mean, 20% down, even with trying to do seller financing or subject to back then, it was just still a pretty high down payment amount. So I was like, man, forget this. Let me just go to downtown and look for cheaper properties. So one of the first ones that I bought was $55,000, and it was rented for $1,350 per month. So I should have known something was up, but the unit was in decent shape. I mean, it needed a power wash, you need some landscaping. There was a tenant in there. And the day after I closed, the previous owner called me and he said, hey, we need to switch you over to Section 8 direct deposit. Give me your email. I'll send you over the forms. And I was like, wait, what do you mean Section 8? He's like, dude, how do you think I was getting a 2%, a 2% rule on this? Like, that's unheard of. No one's going to spend $1,350 on a $60,000 or $55,000 unit. So that's kind of was like sink or swim for me. I was just like, all right, well, let me figure out Section 8. Fortunately, the tenant that was living there, she was elderly. There was no risk. Like, she had no pets, she had no dependents, and Section 8 was paying 100% of her rent. So it was a home run. It just the owner was selling all of his properties. He was retiring and just wanted to cash out. So he had bought it, I think, in 2009 for like 20 grand or 22 grand. So he tripled up, and then the rest was history. But yeah, after I acquired that unit, then I had to figure out inspections. I had to figure out all that stuff to be able to continue to keep buying.
So a couple of observations that I need to make. The first thing is the 2% rule. If anyone doesn't know what the 2% rule is, let's go 1%. If you buy a home for $60,000, 1% of the rents would be $600. So what Tom in effect did was he doubled it, and he was getting over $1,300 on $55,000. That is called nirvana. That is called cash flow. You don't need to be a genius to say, check that box. And I forgot my second point because I'm so freaking excited about the 2% there. It's like, duh. I mean, wow. Let me think about this one for a second because there's so many thoughts that are popping in my mind. Like, okay, you don't even know what Section 8. Craigslist actually is a thing still. We still post on Craigslist all the time.
Right.
Do you still own that property?
No, I've since sold it because it was part of a smaller portfolio that I eventually ended up putting it into. And then I sold that portfolio because that one went from 60 to probably 95 to 100 a door there. So I did a through exchange and then exchanged out into another portfolio.
Wow. So you're buying these deals. You had some seller financing. You're doing some sub-2s. Then you got into the Section 8. Just talk to me about Section 8. Give me some of the pros. There's the good, the bad, and the ugly. Let's talk about the pros first, and then we can talk about the cons and negative parts of Section 8 as well.
Yeah. I mean, the big pros about Section 8 is that the income's guaranteed. When I got started and I was doing condos, I had to keep following up with tenants. My property managers, eventually, they had to follow up with tenants to get the rent. It was never like a certain thing. Obviously, eventually they would pay, but then you had to deal with late fees and it became a headache. So when I discovered Section 8, the federal government guarantees that income every single month. So at midnight on the first of every month, there was a direct wire or ACH deposit into my account for the tenant's portion that was due by the federal government. Obviously, there's a small portion that's due by the tenant. So on a $1,300 rent, it might be $100, $120, $150 that the tenant owes. And then the remaining $1,200 or $1,150 is paid for by the government. That's pro number one. Pro number two is going to be how long Section 8 tenants stay. My Section 8 tenants were staying 3, 4, 5 times longer than my regular tenants. They're not moving for jobs. They're not changing careers. They're not going, to college or having long-term education goals. For the most part, Section 8 tenants are dependent on the government. And I have friends that have been investing for way longer than me, and they have still tenants for 10, 15, 20 years, and it's multi-generational. Their kids will get the vouchers and they'll just stay there, And the third pro is that Section 8 pays way more than regular market rate tenants. So Section 8 has to incentivize landlords to accept the vouchers from the tenants. Because think about it, if you have 2 houses and they're both 3 bedrooms and they're the exact same area, and one pays $1,000, that's regular, and the other one, Section 8, they also pay $1,000. Why would you do Section 8 if you're not getting paid more? And now you got to deal with an inspection by the federal government every year. So they incentivize by having a much higher rent to be able to do that.
What are the negatives? What are the cons of Section 8?
The biggest con is you got to deal with an inspection. The government is in your property every year for 1 hour. Granted, the inspections are not too hardcore. They're mostly looking at, sanitation, safety, and structural. They want to make sure everything is sanitary, clean. There's no debris or, utilities are turned on. Structural, they want to make sure the roof, the foundation, everything inside the house is in good shape. And then sanitation, structural, and safety. They want to make sure there's no holes, no tripping hazards. They want to make sure there's no exposed electrical outlets. So all of these things they're looking for. So a lot of people would see that as a con because, you may not have to power wash your private rental, but if they see algae growth, they might make you power wash that, every year. So things like that come into play. You have to screen the tenants a lot more aggressively. Obviously, you're dealing with lower income tenants. Some of them, are going to have more crime. They're higher propensity for crime when you're dealing with Section 8. Lower credit scores, less reliable. All these things are true, but that's going to happen with any type of tenant. If you don't screen the tenant, it doesn't matter if they're Section 8 or regular, you're going to have a bad experience in your portfolio. So, we go above and beyond with screening. We check to see, we look at where they're currently living. All of my property managers go to where they're currently living and see if there's a bunch of junk cars out the front. We don't, this is an actual thing. We don't rent to anybody with an Android device. It's only iPhone users in our portfolio as of November of last year.
Why?
We found out Android users were getting evicted and removed at a much higher rate than iPhone users. We have almost no iPhone related evictions. All the evictions that we got were always Android. So we just don't rent to them.
So Tom is profiling. That's what he's doing. He's saying Android are morons and iPhone users are intelligent. Okay.
I did not say they're morons. But iPhone users in general have higher credit scores. They have higher incomes and also, for the most part, lower eviction rates. So, and everyone always complains, well, my Galaxy G23, whatever it is more expensive than your iPhone. Yeah. But for every Galaxy G23, there's 200, $29 flip phones from Walmart. And those people that we find in there, for the most part, just are not as reliable.
Oh, wow. I love that. Yeah. As I'm listening to this, I think it's a pro, to be completely honest with you, when you have your yearly inspections. If you're running an enduring organization and you want to scale and you really put resident retention and resident quality and you want to have a great product, that yearly inspection is pretty good because you're forced to go in there and make sure that everything's safe, make sure everything is working properly. A lot of landlords in the market rent space, they don't do that. They get the keys back, and then, hey, the next year goes, and all of a sudden you have stuff falling apart. Give me some idea of the first couple of deals you did. What are some of the mistakes that you made getting into Section 8 in the very first couple of deals?
Yeah, I've made every mistake in the book, right? So I did the trial and error method. I had no mentors. There was nobody really doing Section 8 at scale when I got started. So it was all just figuring it out. So the mistakes that I made, I chose the wrong properties. I bought properties that were not compliant with Section 8, which does exist. For example, if you buy a studio apartment, for the most part, Section 8 will not accept it, especially if they have multiple dependents. They each have to have their own room. I got the wrong financial products. I tried hard money loans. I got, hit with yield management fees, prepayment penalties. I chose, the wrong products there. I chose the wrong property managers. I self-managed for way too long. I self-managed until about 30 units. I was dealing with it myself instead of focusing on acquisitions. So if you can make a mistake in the buying process, I've basically done that. So, but yeah, those are kind of the big ones that I noticed up front.
We teach the framework: buy right, manage right, and finance right. And all those mistakes that you talked about fall into one of those parameters. I want to really peel back the onion on each one of those layers. The first one is the buy right. What is your buy right criteria? Give me a general buy right criteria. It's really difficult, I understand, because all the markets are different. But when I'm looking at Section 8 housing, what are some of the parameters or some of the criteria that I should build into my buy right criteria?
So I'm looking mostly for 3 and 4 bedrooms because Section 8 pays based on bedroom count. So the more bedrooms, the more they pay. So that's the lowest kind of hanging fruit. 2, condition. I'm not buying anything that requires extensive remodeling. If I can't get it ready for Section 8 occupation with less than 5K, I just don't buy it. I'm also buying smaller units, 12, 1,300 square feet below, because the bigger the house, the bigger the headache on the turnover, and Section 8 does not care about square footage. So if you and I bought the exact same location, we both bought 3 bedrooms, I bought a 900, you bought a 2,500 square foot unit. When that tenant moves out, you're spending 5x, what I'm spending on flooring, on painting, on landscaping, on, re-roofing it. So smaller is better when you're looking at, being able to scale and have the most efficient rents. So condition, price, property density. I'm looking to scale. I want hundreds of units in one area. So I'm not buying if there's only 26, available properties under $100,000. and I typically buy in that 60 to 100K range.
And the is it the 1% rule? You're getting 1% on average for the price point.
No, I'm looking at 1.5%. So like on a 900 on a let's say on $100,000 unit, I'm minimum going to be like $1,500 in rent there. And that's what Section 8 is so great with, is that they're going to be able to pay a lot more in rent. Because I mean, 1%, I'm not getting it. For $100,000 and I'm only getting $1,000 in rent, it doesn't cash flow. Or if it does cash flow, it's going to be so slim that you're going to be stressed out. So the beautiful part about Section 8 is once you get that $70,000 door, you only really need $1,100 or $1,200 a month in rent to already get close to that 1.5 or 1.4%, rule. Because they just naturally incentivize landlords, so they pay more.
Now the manage right, the wheel of the wheelbarrow is the manage right portion. It's in constant motion. You said that you had managed your properties up until 30 units. Give me some really good tips on managing Section 8 housing.
It all comes down to inspections. You get all these Mickey Mouse kind of mom and pop investors that get started and they do one Section 8 and they get burned on it, and then they say that it's the worst program in the world. It's because they don't know how to manage. They didn't screen the tenants. Just because the income is guaranteed doesn't mean the tenant quality is guaranteed. And I always tell that to my students. It's like, you still have to make sure that they're a good tenant. I still look at credit. I don't care if Section 8 is paying 100% of their rent. If their credit score is on at least 620, I'm just not renting to them. It tells a lot about a person. If they have a 520 credit score and they owe money to Verizon, to the water company, the power company, it's just not going to be, they're not going to keep their promise. They're not going to keep up their end of the lease. They're not going to take care of the property. We notice a direct correlation between the lower the credit score, the more they trash the property. It's almost every single time. So these are all big things that we look at. And the biggest thing is inspection. We don't care about the annual inspection from Section 8. We're doing quarterly inspections, and we also sometimes throw in a surprise inspection if my property manager drives by and notices something sketchy. Well, hey, here's your 24-hour notice. We're coming tomorrow to check it out. Are you smoking in there? Do you have pets in there? Do you have 10 more people that shouldn't be in there? And then the biggest thing is just following through with your policies. We'll evict them. We just do not care. The amount of cash flow that we have coming in, throughout the other properties will more than offset an eviction. So if you don't follow through your own properties, it's a small community. Wherever you're buying, doesn't matter if you're buying in a big city, everyone on Section 8 knows everybody else on Section 8. And if you come as the investor, know that you won't evict, or you'll give them an extra month, everybody will take advantage of it.
And let's not forget the iPhone users. They've got to have an iPhone. If they don't have the iPhone, X-Nix.
So we text them the applications. That's how we know if they have an iPhone or not. So if they respond back or they reply back to that text and it's green, it's a disqualification.
That's so funny. And the next one is the finance right. How are you financing these properties?
I've done basically everything. Right now, I'm mostly buying cash and DSCR loans. When I got started, I did a lot of seller financing. I raised a lot of OPM, so I had several partners that I was able to raise money with that I met at like Cars and Coffee events or met at Real Estate Investor Association events. So I basically raised money every possible way that you can think of. But right now, it's mostly DSCR commercial loans.
And as you're buying these assets, I think most investors never think of exit strategies when they're buying deals. And that's part of the problem with multifamily. They're thinking of buying this multifamily, and for the next 25 or 30 years, they're going to own it. They may, but things change. Interest rates rise, debt comes due, the economy softens, the market turns to crap. A lot of your tenants don't have iPhones, so a lot of that happens. What is your exit strategy in a lot of these assets? As far as, are you going to bundle up in portfolios, sell them, hold them long term to cash flow? What are you looking to do with your assets?
So right now, it would more than likely be get to 1,000 units and then sell to either a hedge fund, or I would just peel them off and sell them individually, because you get so much more selling to first-time home buyers than to try to. And I wouldn't be in any rush, right? Right now, I'm cash flowing. It's a well-oiled machine. I have my property managers in place. I trust them all. It works really well. I have no incentive to sell. So if I were to sell, I'm going to lop somebody's head off, right? It's going to be a super high margin, at least a 2 or 3x multiple per property before you're going to get me out of that unit. So to answer your question, I don't have a set exit strategy. I would say that if I sold all 722 units, I would probably net in the neighborhood of around $75 million, which obviously would be awesome, but I have no plans for that, in the future. So yeah, that's kind of where I'm at.
Let me ask you, as far as the market, how do you select the market? You said you need density, but are you in certain areas like Memphis, Tennessee? Are you in Knoxville, Tennessee? Are you in St. Augustine, Florida?
Yeah, I'm buying mostly in the Midwest and the Southeast. So like I started in North Carolina. I started in Wilmington, North Carolina. That was kind of my backyard. So the majority of my properties are there. When I started expanding out of state, I'm looking for several major factors. I'm looking at, like I said, the density of units. That's the number one thing to make sure there's enough properties to buy there. Also condition. There's a lot of markets with a lot of, Section 8 properties, but they're all trash. Look at Florida. You come down, look at Florida, anything under 100 grand, they're going to be double wide trailers in the middle of nowhere that you're never going to find a property manager to handle. So it's going to be that availability of labor. Like I said, management, handyman, it's going to be really important to make sure that you can get that. So I don't buy in super rural areas, but I also don't buy in major metropolitan areas. So I like these secondary, tertiary markets that are going to have good cash flow. Because also if you buy in the middle of nowhere, Section 8 knows that, so the rents are lower. So it's not as efficient when you're, buying units at scale. So if you can't even buy them because you might be able to buy 2 or 3 per month. So those are kind of the main things that I'm looking for. As far as actual properties in the units, I look for public transportation. Section 8 tenants love public transportation. Crime's a big one. So I want to make sure that I'm not buying in a war zone, meaning, high narcotic activity, a lot of violent activity. I'm not looking in areas that have a high concentration of sex offenders. All of these things kind of play into it when I'm looking for a new market to buy.
You're sitting at 30 units and you're like, dude, I can't keep doing this. I need to scale. How do you go out and find property management companies?
Yeah, so I did it. So when I started with, actually, I take that back. The first couple months, I did have a property management company. I found a third-party property management company in Wilmington. It was just a referral through my real estate agent. That was literally it. The problem with that, though, is most property management companies are trash. They have no idea what they're doing. And if you only bring them a couple of units, they're not going to give you priority. Like if I use a property management company right now and I give them all 722 units, they're going to give me priority over the guy that has 1 unit, right? So I was noticing that my units were staying vacant longer than when I was managing them. I noticed that they weren't getting as much rent because they didn't really know what to look for in a Section 8 tenant, which is an art in itself. If you go ahead and you get a tenant that's got a full-time job, they're going to be paying half that rent. And that defeats the whole purpose of Section 8. The more financially messed up they are, the better it is for you as the investor because the government helps them more. So a lot of times the property management companies didn't understand that. So it's just a matter right now. I've been doing it long enough and I have students all over the country where we kind of know the best property management companies. But when I got started, it was kind of hit or miss. Eventually, I got rid of that property management company, hired a full-time person, paid them $4,000 a month, and then they were managing it, and that just worked so much better.
I like that. And as you're scaling, what are you teaching your property manager? I like the idea that, hey, you want to be financially qualified, and the fact that you at least have a 620 credit score. Yeah, you have a pulse. You don't want to be the person going out there making 80 grand a year because it's going to defeat the purpose. You want to make sure that rent gets collected. You want to make sure that you're on top of the paperwork bureaucracy. You want to make sure that you're doing your yearly inspections and maybe even quarterly. What are some of the things that property management company that you're running that you have right now that the company that you had previously was not doing?
Yeah, so the first thing that I'm doing is the property manager that I'm hiring has zero experience. The least experience, the better, because they don't come in with all these notions about Section 8. So I like between 25 and 35 years old, right out of college, still hungry enough and want to prove themselves. That works really well for a property manager. Also give them incentives and bonuses. Like, hey, if you rent, these properties within 30 days, then I'll bonus you at the end of the quarter. So incentivizing that makes it a lot easier as well. And as far as training, I have my own property management software. It's called Cruise Control. So it's designed for Section 8. So I just teach my property managers how to use Cruise Control, and it basically walks them through the whole process. Hey, add the property, add the tenant, connect, if they have a credit card to pay their portion, sign the lease, and then kind of, get to it. But yeah, I mean, that's basically the process to onboard a new tenant.
The irony of a gentleman sitting in front of a Ferrari, I think, and he's got a program called Cruise Control. That bad boy is never on Cruise Control. I'm telling you that right now. So
Yeah.
I love the branding, and this is something important for anybody listening to this. Tom is building an enduring business. He's implementing systems within his business. He's just not going out there buying a house here, a house there, a house everywhere. He's implementing systems. He's buying right. He's financing right. He's managing right, and he has his own property management software. So if and when he decides to package everything up in 10 years and he has $180 million worth of assets that he can cash out, he also has additional streams of revenue. I was just talking about this on another podcast 10 minutes ago. He has intellectual value with his management company right there. He has an education company that he can also sell as well. He's creating a brand. Let's talk about that. When did you have the epiphany of saying, man, I got to start branching out. I got to start making some money elsewhere?
I mean, that was also an accident. Basically, everything that's been super positive in my life has been accidents that I've just doubled down on and just kind of ran with, including starting with Section 8. But as far as the online stuff and the education stuff, that started in 2020 during TikTok. I basically was in quarantine like everybody else. My sister got me on TikTok. I started scrolling and realizing that, hey, like, let me just post some video. It was the only platform where I saw that nobodies were just getting viral videos overnight, right? So the very first video that I posted was me buying a car for my dad for Christmas, and he got all emotional because he'd been wanting the car for a while, and it got 12 million views overnight. I had 60,000 followers on TikTok in less than 48 hours. So then people started wanting more. So I started putting more car because I've been collecting cars for a long time. So I posted more car videos, more house videos. I was remodeling a house right when COVID started. And then it just took off. And now I'm at like 1.2, 1.3 million followers on TikTok. And then people were just asking me questions like, hey, how did you get that Lamborghini? How did you get the Rolls Royce? How did you get the Ferraris? And then I just was answering questions every day. I started doing Zoom calls and just let free Zoom calls, let people in. And then eventually it just made sense to just make a course about it. I just put together a whole educational, it was very, very like rudimentary at the beginning. I literally just took a webcam and a Loom call and a PowerPoint and put together my initial course. And people were super interested. I was the only one talking about Section 8. Now there's been a few other, random Section 8 coaches that, jumped on the bandwagon and have been doing Section 8 all of 1 year. But that's basically how the education started.
Let's take a quick time out to hear from our sponsors, because on the back end, I want to discuss a little bit about the education company and also scaling up.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework, buy right, manage right, and finance right.
Now, Jake and we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily. We are back. So now, Tom, you've been doing this for a couple of years. Before I jump into the education platform, how did you scale up? Because people are going to say to themselves, Tom, how do you get the money? How do you have the time? Like, how do you go into different markets? What was your journey? And listen, I love how you say everything that happened to me in life was a mistake. It's like, oh, I got lucky. It fell into my lap. It's hard work, Tom. You work your ass off like anybody else who's made money in this country. It doesn't come easy. You make mistakes, you get kicked in the face, and then you say to yourself, okay, I got bruised up a little bit. I'll do a little bit better next time, and you figure it out. So, I mean, how does somebody want to start scaling up in this business?
Yeah. And I mean, as far as the luck aspect, it was just about finding the idea that was lucky. As far as being able to grow to this point, yeah, it took a lot of blood, sweat, and tears. But as far as how to scale, it all comes down to being creative. I mean, at the time, I was, like I said, I was doing web design and SEO when I started doing wholesaling. I was maybe making, $3,000, $4,000, $5,000 per month, depending on the month, if I had any new clients or if things were going well. So I didn't have a ton of money to get started. Neither of my parents were in real estate. Neither of them are independently wealthy. So I really just had to kind of, bootstrap it and figure out exactly how I was going to do it. And that came eventually with wholesaling to get my first few units. And then from there, I was able to start buying properties on my own, 1 or 2 at a time, with the funds that I had from wholesaling. And that came through seller financing. I did a lot of seller financing in the beginning, putting lower down payments, avoiding banks as much as I could. After I did that, then I started, I had 15, 20 units that I had accumulated over the first couple of years. And that's kind of where I hit that epiphany where I was like, look, I can't keep saving 20%, saving 10%, buying, saving 20%, buying. I had to grow a lot faster or I was going to be stuck in this mom and pop investor phase for life. So that's when I started raising other people's money. It was so much easier for me to go to a cars and coffee event, find the guy with the most expensive car and say, hey, look, man, like, what do you do? Blah, blah, blah. Can I take you to lunch? I have, this 40 unit apartment or single family portfolio that I want to get into. And then, who's going to turn down a real estate opportunity, especially if you already have a track record, which I did. okay, here's my trailing 12-month bank statements. Here's the $45,000 a month that I'm generating from Section 8 rents right now. I'm netting $23,000. I want to buy these 45, 50, 100 properties. And then once you get that first investor that's interested and you can give them a decent return and they obviously see that their money is protected by real assets, it's not a hard sale. And that's how I was able to grow. The first unit, I think, was 40 units that I got with an investor. And then I got raised money from another investor. We bought 92 units in Wilmington, North Carolina. That was the largest single family portfolio sale in the county's history. And then I just kept going. I just eventually what I would do is I would occupy all those units with Section 8. If they were vacant, I'd put Section 8 in it. If it was a regular tenant, we would raise the rents. If they couldn't do the raised rents, we would replace them with a Section 8 tenant once their lease expired. And after a year, 18 months of stabilizing those portfolios and forcing the appreciation, we did not do any renovations or remodeling on these properties. We left them as is. We got them Section 8 ready. We got super high rents. And you take 92 units and you take them from $30,000 a month in rents to $120,000 a month in rents, the valuation goes through the roof. I did a cash out refinance, pulled the equity out, paid off my partner, and retained the units for myself. And then once I started having enough units to be able to fund my own deals, then I was able to wean off of partners and not having to raise OPM because I was able to just, self-fund.
And how long did that journey look like for you? How many years did that take?
That was a 4-year process. Like I said, wholesaling for a year, year and a half, buying on my own for probably almost 2 years. So I think that's about 3 years. I think about 3.5, 4 years is when I started really putting the foot to the pedal and try to get as many properties as I can.
So it's interesting. Behaviors are belief driven. If you're listening to this and you're saying to yourself, I'm going to go out and buy 100-unit multifamily in my first deal. I'm not saying you can't because a lot of our students have done that. But if you don't think you can do it, you're not going to do it. We always say, think big, start small. Your very first deal you get into, it may be only a duplex or a triplex, but you get it. All of a sudden, you've got credibility. You can go to an event and say, hey, I'm a closer. The brokers will take you seriously. Then from a 3-unit, you go to a 6-unit. And then what Tom did, he got his 40-unit portfolio. And then from 40 units goes to 90 units. That's the progression, because God help you if you buy a 100-unit portfolio and you have no experience, you're going to make a ton of mistakes. The learning curve is a lot more dramatic. And if you do make those mistakes, it may be very costly. But if you're buying a $150,000 single family home that's generating $1,800 a month, there's not much error there. You can survive the blows, and then you learn something from that, and then you grow, right? Think big, start small.
And that's something that I noticed that so many people underestimate, and they just don't even think about it, is the power of just buying that first unit. Because everyone has in their head, like, oh, if I only get one unit, it's only like $300, $400, $500 per month.
Yes.
But you're discounting the fact that now you overcome the fear of buying, you get the momentum, you already start building your property management team, your inspection team, your handyman team, you start getting your processes and your systems in place, and then it becomes like addicting, like, oh, wow, I'm making $500 per month doing very little work after you set up all the front end work. And then that's where it really propels you to buy your second, third, 100. If you can buy one property, you can buy 1,000 properties. It's the same process. You're just copy and pasting it and doing it in a little bit different ways if you're financing differently. But that's what most people discount, is the value of just closing on that first unit, going to that title company, signing on the dotted line, and like getting that momentum.
I've always heard, I don't know who said this, but we always underestimate what we can do in 5 years, and we overestimate what we can do in 1 year. Within 4 years, Tom's got a very nice portfolio humming along. Jake and myself, after buying our very first deal in 2013, it's 2017, we've got probably 700 units, and we're generating X amount of, it was the portfolio was great. We had refinanced out probably $8 million out of the portfolio. So it's amazing what you do. You just stop because you get overwhelmed. You're thinking about all the cars that Tom's got behind him. How am I going to do that? It takes a couple of years. Tom wasn't born with the silver spoon. He had to work through the process. Don't worry about the next deal. Worry about the first deal. The first deal takes care of itself. Then you go to the next deal. And then if you don't have money, you'll figure out whether it's seller financing. There's a lot of tools out there. You have the seller financing tool. You have the syndication tool where you can raise capital. But if you're thinking about, I don't have the time or I don't have the money, that's where you get stuck. Those beliefs will hold you back. Now, you've created this great course about Section 8. Talk to me, walk me through how I can get, involved in the course, what the course is all about, what I'm going to get from the course.
Yeah, so I actually built, it's a whole actual Section 8 platform. So the way it works is we do webinars weekly. So if you go to section8webinar.com, you can enroll for free. I have a 1-hour live webinar where I teach you But basically, it walks you through all parts of the process, from identifying the best gold mine properties, from closing on them, how to get seller financing, how to be able to put together property managers, how to do this from out of state. Because most of the students that I work with are in New York, California, they can't buy there. So I show you how to buy these properties from out of state. And then I also talk about how to scale. How do you raise OPM? How do you set up those operating agreements? How do you do all that? That's all included. And then I also sell access to Cruise Control, which is my Section 8 property management software. And then I also have a deal finding software that shows you all the best Section 8 properties in the country and also parses out all the ones that offer seller financing. So that's all available at section8webinar.com.
Tom, it's interesting. I want you to tell me some of the characteristics that a successful student has in your community. Because I'll give you, for instance, for us, when we have students who come on the Jake and Gino community, they're either in single family homes, they understand the power of real estate, they own a couple of multifamilies and they want to scale. So we're teaching them how to manage, property manage, and asset manage, and or they're really successful entrepreneurs, small business owners. They're really, high net worth doctors, lawyers who want to get into the multifamily space. Who are you specifically looking to target to get into your platform, into your community? And what are some of the characteristics they have?
Yeah, I mean, the most successful students have at least $15,000 in cash. You have to have some money for down payments and repairs. There's no other way around it. No matter how much people say you can get started with $0 down, it's not a reality. It's not common. So I would say $15,000 starting cash. You have to realize this is not get rich quick. I do, this background because it's engaging and people will stay on longer if I have the cool cars back there. But this took 7-8 years to kind of get here. You can get your first Lambo in 3 or 4 years, depending on how much money you have to start with, how much you reinvest, how creative you get. But I think the biggest traits are going to be creativity, tenacity. You have to talk to other people. You have to talk to real estate agents. You have to talk to other investors. You have to, be able to communicate. And then I would just say kind of determination, which is very cliche, but it's really what it takes. The amount of students that I'll get on a coaching call with, and they're like, man, I don't know if this is for me. I was like, how many offers have you made? I was like, 2. They made 2 offers. You're expecting to get your first home run deal by calling 2 agents and one of them didn't even pick up? Like, what do you mean? So I think a lot of people expect this to be some overnight success. They get their first property and now they can go buy the Miami beachfront, condo. And it's not the reality. I mean, you're going to need at least 30, 40, 50 units to really start seeing meaningful volume. Most people that have a $60,000 a year job, netting $4,500 per month can replace that income with 10 or 12 houses. So it's really not that big of a pipe dream, especially after you buy your first one and you realize how easy it is.
It can be life-changing. One more question before we wrap up the show, because I really wanted you to focus on the out-of-state, because that's one of the limiting beliefs that most people have is, I have to go and touch all of my homes. And that usually always drove me nuts, because that's not the reality. That's a limiting belief. That's somebody who's telling you, your uncle, your aunt, saying real estate's risky and you need to be, on the property all the time, talking to all your tenants. How do you start scaling from out of state?
Yeah. So I think a lot of people forget that it's 2024 and we have FaceTime and we have home inspectors and we have appraisers and real estate agents and handymen. Like, there's no reason not to be able to buy out of state. If you have a phone and you have internet, then you can call a real estate agent in another state. They'll do a FaceTime walkthrough of the property so you can see it just like you're there. And then you can spend $300 on a home inspection and they'll give you a full report of everything that's wrong with it. So, I mean, I don't even think I've flown over half of my portfolio because I'm buying in, middle of Nowheresville in the Midwest. So I've not seen over half of my, probably 60% of my portfolio I've never seen in person. It's all just through pictures, videos, and inspections. So if you're in a really expensive area, and I hear it all the time, like, oh yeah, you can't buy a $70,000 property where I'm from. Well, duh. I can't buy a $70,000 property in Miami either. So I don't. I just buy out of state. And then you get a property manager. And if you want to go there for the weekend to, touch the house, a lot of people have this thing where they have to go touch the house and like see it's real, as if it's not in some, neighborhood in the Midwest. So go out there, spend the weekend there, go touch it, go shake your property manager's hand, do whatever you need to do to feel better about it. But don't just do nothing, because then you're never going to start your portfolio just because you live in an expensive area.
There's a couple of things I would add, just if you're going to invest from out of state, and you're that kind of person that needs to touch everything and to kiss everything and to lick everything. I get it. I was there at one point. Get on a plane. Google's great, but get on a plane, get a feel for the community you're going to invest in. Start walking around. That's the opportunity to meet real estate brokers in the market, to meet real property management companies in the market, so you can have a specific conversation with them, introduce yourself so they know that you're real. I mean, Tom is real now. Tom doesn't have to do that because he's got the presence. So he doesn't have to waste his time doing that. But if you're just starting out and you're serious and you want to make $4 to $5 grand a month in the next 24 months, get in a plane, scrap the money, select a market, go fly out there, talk to a couple of brokers, interview them, talk to a couple of property management companies, interview them. Let me back that up. Invest in Tom's program and then start doing that, because that's important, because you can either learn on the street or you can learn in the classroom. And learning on the street is a hell of a lot more expensive than learning in the classroom. We can go on about that for the next 3 hours because I've made those mistakes. It's really important to take some capital, invest in your education, because this is super hyper focused. Section 8 housing has certain parameters and certain things that you need to know. Why make mistakes on that very first deal where you may lose all of your capital and then say, hey, my Aunt Martha was right. Real estate was risky. You should have listened to Tom. You should go and invest in the education. Any final words before we sign off, Tom?
Yeah, I mean, I'm on Instagram, guys. It's T Cruz, TCRUZNC. I respond to my own DMs. If you have any questions about this podcast, or if you want to be able to join the webinar, that's Section 8 webinar, the number 8 webinar.com. But yeah, I'm available. I'm also on TikTok, same username, TCruzNC. And I'm always online. And if you have any questions about getting started, or if you are about to buy your first property, you want me to look at it, just go ahead and reach out.
I love that. And Jake, this wrap up is for you, brother. Since you're not here right now, you're in Niagara Falls somewhere having a good time. You know, Tom Cruz, young guy, he's out there, he's doing web design, SEO, and he's like, let me buy a condo. I heard this real estate thing is good. He buys it. He makes his first mistake. He doesn't look at the covenants and restrictions. Yeah. He's got a dog, and he's like, bro, I'm not parting way with this thing. I'll get rid of my house, but I ain't getting rid of the dog. So what does he do? He goes out and buys another deal. And then he buys another deal. And all of a sudden, one of his deals, he buys a Section 8 deal. He doesn't even know he bought a Section 8 deal.
Exactly.
Like, holy crap, 60,000? I'm getting the 2% rule? Something's wrong here. No, nothing's wrong. He just got lucky because he worked really hard. And then he figured it out. And then he got 3 units and then up to 30. And he's like, holy crap, I can't keep doing this. I got to scale. How the hell do I scale? This coffee and cars thing, I got to go meet investors. He meets an investor, 40-unit portfolio. Buys the deal. And some of you may say, well, I don't want to partner. I don't want to give all that up. Well, you ain't giving nothing up, because look what's behind Tom. He didn't give up that much to get where he is. You got to give in the beginning to be able to do that. And from the 40 units, all of a sudden he buys a 90-unit portfolio and continues to scale. And then all of a sudden starts putting his education community together. Well, even before that, gets on TikTok, of all places, in 2020. He's bored. He's like, I got nothing to do here. I'm locked in. What the hell am I going to do? He makes his first video, 12 million hits on his first video, goes viral, 60,000 followers. And from there, he's up to over 1 million followers, continues to grow. Got the platform, the property management software, the deal finder software. And all of a sudden, he's got over 650 G's a month coming in Section 8. Well done, Tom. Thanks, brother.
Thanks for having me.
My pleasure. Once again, that website.
Yeah, it's Section 8, the number 8, and then webinar, webinar.com.
And Jake, once again, this is for you. Real people doing real deals. This is Jake and Gino signing off. We'll see you next week, everyone.